Hi, I'm Roger Montgomery from Montgomery Investment Management, and on behalf of Advice First and the team here, I'd like to talk to you about our returns over the last 12 months and how we're seeing present market conditions. So if we look at the performance of the Montgomery Fund over the last 12 or 18 months, one of the things that you might notice is that we've underperformed the market. But you've got to remember, the way the market is constructed is not the way we construct our portfolios. We focus on quality. And unfortunately, the Australian market is not, or if you like, the Australian market is filled with businesses, very large businesses, that are mediocre and not necessarily very high quality. For example, it might surprise you to know that the Australian ASX 200 is weighted 17% to resource companies. Now, BHP over the last 10 years has the benefit of 3 times as much debt and twice as much equity, and yet it's earning less than it was earning 10 years ago. Unsurprisingly, we don't own BHP in our portfolios. Now, last year, calendar year 2016, BHP rallied 77%. We don't own it, so we're bound to underperform in that scenario. A company that we do own and that we do like is a company called REA Group, which owns the realestate.com.au website. They have the power to be able to raise their prices, and despite raising prices every year for the last 3 years by 10 or 15%, they seem to have more customers and more people using their service. Now, that's a business that we really like. And while it's made a lot of money for us over the years, last year, 2016, it went sideways. And in fact, between July and December last year, the share price fell 30%. So if we're going to focus on high quality businesses rather than resource companies, and resource companies rally by 77% and high quality companies fall in price, we're bound to underperform. But I want you to know that we're not changing what we do. We aren't going to suddenly decide, hey, BHP's going up, let's buy it because we don't want to miss out. We're going to continue focusing on high quality businesses. And while last year BHP significantly outperformed REA, if you look back 10 years, BHP is only up 9%. That's total over 10 years, whereas REA is up almost 1900%, a 19-fold increase in 10 years. So we're going to continue to own REA and we're going to continue to avoid BHP. The other reason for our underperformance last year was the fact that we held a lot of cash. With 25% cash in a market that's risen 15%, it's bound to be a drag on performance. But we also know that if the outperformance of the stock market is due to the rally of stocks that we don't think will continue to rally, then ultimately having cash is a very smart thing to do. And at some point in the future, we think that cash is going to come in very handy. Keep in mind that if the market does fall, having 25% cash acts as a very, very healthy cushion. Okay, what about current market conditions? Well, one of the things that we know is that the market is very expensive, broadly speaking. The ASX 200 is now on a PE ratio of 18 times, which is 7% higher than just before the GFC, at the peak then. Now, of course, that doesn't matter very much when interest rates are much lower, but you've got to believe that interest rates can't stay low forever. If interest rates start going up, and keep in mind banks are already raising interest rates out of cycle, then the cost of funding starts to go up, the present value of future cash flows starts to go down, and that means that the PE ratio, the majority of the PE expansion, by the way, has been due to simply people's willingness to pay more for shares, that will start to reverse. So we're in no rush to invest that cash. We also know that we must be in the late stages of a boom. How do we know that? We know that for 2 reasons. Number one, more of the money is being concentrated in fewer and fewer stocks. And in the United States, we're seeing that with the FANG stocks. So Facebook, Amazon, Apple, Netflix and Google. We know those companies are capturing a rising proportion of investors' mind share and also a rising proportion of their wallet. Now, we think that could last for some time, but it's just a sign to us that we're in the mature phases of a bull market. And the other sign is that we're seeing records smashed for assets that produce no income, like art, low-digit number plates, collectible cars, and even, believe it or not, second-hand runners and footwear. At auction, these things are hitting records and reaching prices that astound even the auctioneers' pre-auction estimates. So with that, I'll leave you with your advisor to talk about the Montgomery Fund and to talk about present market conditions. Know that we're always on the lookout for high quality and value, and that's not going to change anytime soon. I look forward to receiving your questions through your advisor, and thank you again for your time.